Hope everyone had a great day. My name is Gary Lipsky, president and founder of Break of Day Capital, and this is what a reset market really looks like. Over the next 30 minutes or so, I'll cover what we're seeing in the multifamily space, why we believe now is a tremendous time to invest, and share an opportunity with you. Then I'll be happy to answer any questions you may have. Without further ado, let's begin. So here's just a general disclaimer. Protects you, protects me. You guys can read it another time. Here's more. All right. So a little bit about us. If you haven't worked with us before, Break of Day Capital, we've raised over $110 million from investors to date. We've distributed over $40 million to investors. We've acquired over 1,800 units through 14 deals. So very selective over time, and strong focus on asset management. I wrote a best-selling book, Best in Class on Asset Management. And over the first 12 deals, we've averaged a 40% bump in NOI growth in year one. Also wrote another best-selling book, Invest Smart. Have a podcast we've been doing for, wow, I think a little over 6 years now. We've done over 260 podcasts. I've been on probably at least 100 podcasts or more of other people. And we were voted the best syndication company in 2022 by AAOA, which has over 140,000 members. It's not just me. I have a great team. Tim, our director of asset management, he's has over 10 years in senior institutional real estate roles, and he's led asset management and redevelopment of over $4 billion in multifamily assets, overseeing over 10,000 units. Joe Fang, our director of investor relations, he actually started as an investor. He's probably invested in at least 10 of our deals. Started investing in real estate since 2003, and he's a specialist in macroeconomics and data analysis. Sean's our director of operations. He's been investing in real estate since 2005. He's an expert in AI automation strategy and deployment. Jacqueline's a backbone. She helps do all the stuff behind the scenes. She's been investing in real estate since 2002. And Andy Wong, our investor relations manager, over 20 plus years overseeing institutional and private investment portfolios. So great to have a team like this to help us drive our decisions and to improve everything that we do. So 2022 versus 2026. In 2022, you have had low cap rates, low interest rates, high leverage, and lots of investors chasing deals. So cap rate is what someone is willing to pay for the net operating income. And in 2022, in most markets, every market is a little different. In Tucson, let's say, for $1 million of NOI, you would pay a 4% cap rate, and what that means is you would pay $25 million for that property. Today, that's that same 1 million divided by a 6.2 cap rate, the going rate that we bought Icon on Broadway with, you would pay $16.13 million. So massive, massive difference. Much higher cap rates, great time to buy, bad time to sell. So let's talk about the stock market. It's near all-time highs right now, whereas multifamily is near 13-year valuation lows. So do you want to invest where there are all-time highs right now or near 13-year lows? And here's a slide that talks about the four real estate asset classes. You got multifamily, industrial, retail, office. There's more. There's self-storage, there's mobile home parks, senior housing. I saw this slide and I thought this was really cool. Um, Multifamily is the best risk adjusted option out there right now. Um, it's solely to the left, so the risk is low because everyone needs a roof over their head. We have a massive shortage in housing. Depending upon what article or what source you read, it could be a million to many millions. Um, but what we do know is owning a house these days is much harder. Homeowners insurance has gone up 70% since 2021. Purchase prices have gone up. Interest rates are significantly higher than a few years ago. And you also have disincentivized sellers with low interest rates. So they don't want to sell. And we had almost 40 million renter occupied units in 2010. And now we have almost 46 million in 2023. So a massive shift. We've become such a renter nation. And that's why I love multifamily. So why now? On a deal we just bought, we bought it at 50% below replacement value. So 110 a door. So if you built it new, it would be at least $220,000. Now, granted, that's new and this isn't, but that really protects your investment by having that basis. Um, Everyone's probably heard this quote from Warren Buffett: "Be fearful when others are greedy, and greedy when others are fearful." Well, it's great to say that, but I think a lot of people are scared to do that, greedy when others are fearful. And then now's that time, I believe. Um, but it's hard for people, people want to invest with the herd. If things are everyone's jumping in, then a lot of people want to jump in. But this is the time that we all kind of been waiting for in real estate. Again, great time to buy, bad time to sell in multifamily. So position capital is one thing, but execution is just as important. So investing with the right operator. So an operator that assumes imperfection, not optimism, because this is a business. There's going to be ups and downs. Things break, and so if your underwriting is razor thin, looking for that perfection, that is a recipe for disaster. You've got it built in your capex plan, in your rent assumptions, um, in your ability to increase NOI over time, managing expenses. That execution is so important, and that's why for us, we focus on a few markets so we could be experts in those markets, and we've executed time and time again. Like I said, in our first 12 deals, we improved NOI 40% in the first year because we were able to find true value add and execute on those deals. The last two deals have been more um, core plus, more of a cash flow basis, and that's because of our from our investors, that's what they want, and so there's less of a value add play there. So in some uncertain markets, projections don't determine outcomes. Execution does, and this is our secret sauce. This is our list of our portfolio. So we've done over 1,800 units. That's our next column is our purchase price, the amount we've raised. It doesn't have Icon on Broadway. That's why it's over 110 million dollars. And our four exits that exceeded expectations. So Icon on Broadway, this is the opportunity I was talking about. We closed about a week and a half ago from when this is being recorded. Very excited about this deal. We have a property that is about a mile away, two others that are within a few miles, and this is our ninth property we own now in Tucson. So great economies of scale, 1,600 units. That means we get better pricing from vendors, great relationships with brokers, lenders. This really helps minimize our costs and maximize our profit. So as you can see, 300 units, just under $33 million for this purchase, just under 110 a door. Our loan to cost is 64.5%. We got a 5-year fixed rate loan at 6% and 5 years IO. We also got an appraisal that was $1.75 billion above what we paid, which is great. So when you invest, you've got that already a really nice premium that value as soon as you invest. For people that invest under $500,000, we project a 16% IRR and a 2x multiple over a 5-year period. So we look to double your money in 5 years. If we can do that sooner, and we've done that in the past, then great. We can look at the opportunity to potentially sell that property. But we'll constantly be monitoring the market, where it's heading to, and how much more value we can extract out of the opportunity. For those looking for tax incentives, and this is not built into our IRR or equity multiple, but if you invest $100,000, you'll get at least a $90,000 loss on your K1 in year one, and there'll be more depreciation going forward. And these are projected numbers, but if you can't use it right away, because you can only use it against passive gains, you can always carry it forward and use it when we sell the property, which is great. You don't get that in stocks and other opportunities, but that tax benefit really, really rocket fuels your net worth. We also have conservative underwriting. So we have 0% rent growth in year one, 1% in year two, where the projections are 3% or more, and cash flowing 6% in the first year, and going up slightly over the as we increase NOI over the remaining years of the hold. So key risks and how we underwrite for them, because we always want to evaluate what risks, what are our blind spots, what are we missing, what do we need to underwrite for to protect your investment. So for, like I mentioned, slower rent growth, that's why we assume 0% rent growth in year one, even though they predict 3%. And that protects you and us. Expense risk, and this is something that we've always excelled in, minimizing expenses. Again, having these bigger properties, having many units in one market helps us reduce our expenses. And our pro forma reflects current elevated costs, not historical lows. As far as interest rate and exit risk, we don't have really cap rate compression, and we have fixed rate debt for 5 years at a really reasonable interest rate, and that helps protect your investment. And then execution risk in managing a 300-unit workforce housing asset. I mean, we work with a third-party property management company. We have very strong asset management. We know this market really well. Like I said, this is our 12th deal in Tucson. And so we have thousands and thousands of data points. We're not looking for deals all over the country. We just focus on a few areas so we can be experts in those areas. And then like I said, we oversee our property management company on a consistent basis. So here's our business plan. Brand repositioning. So it was called River Oaks, and we'll transition that to Icon on Broadway. Icon on the Street is a moniker that we use across almost all of our properties. We have targeted amenity upgrades, so package lockers, and that will allow our residents to get their packages 24/7, 365, versus relying on our staff. So it saves them time and makes our residents happier. We'll also build out a pergola and a barbecue area, which we've done before at some of our other properties. We'll do a physical research, so increase the curb appeal, some painting, address some deferred maintenance, redo the parking lot. Also cost discipline, so we'll be able to reduce some of the operating expenses. Our capital stack, we're looking to raise a total of about $13.5 million. Our debt is $24.5 million. We had closing costs of just under $1.2 million. That includes we bought down the rate a point. We also had a lender fee, a broker fee, legal costs, insurance, escrow fees. It all adds up when you're buying a big property like this. We have over $2.9 million for CapEx with a lot of buffer in there, and I'll go through it in more detail. We have $350,000 in working capital besides the cash flow that we'll get and an acquisition fee. This is a renovated unit at Icon on Broadway, and 85% of the units are renovated. So really nice, workforce housing. I love this slide. The sales comparables, as you can see, we paid just under 110 a door, which is well below what others have paid based on the vintage. And if you look further right, the per square foot, $155 per square foot versus the nearest comp is $205. So we got a really, really good deal on this property. If you don't know the Tucson market, it has over 1 million people in its MSA. The median household income is over $72,000, and unemployment rate is fairly low. Tucson has a very diverse job market, which I love, and that helps protect investors as well. We've got healthcare, aerospace, IT, warehouse, finance, education. So lots of different employers, and we're not relying on one or two. And God forbid if they left the market, that hurts occupancy. What I also love about this property is that it's on a very busy street, Broadway Boulevard, across from Home Depot, PetSmart, Sprouts, Kohl's, Ashley Furniture Store. So great, great location. That will drive traffic to our property, lower our costs for finding new tenants, new residents, and making it really easy for our current residents so that they can just go across the street to get the things that they need. Makes life living at our property very easy. Also, on to the left of our property, there's medical office space too, which is great. So here are the investment classes. We have Class A, and that's people that are wanting a higher cash on cash return. However, there's no appreciation and there's no depreciation. So there's pluses and minuses to that class. But we sometimes we have people do prefer that class if they're on a fixed income, or they do maybe sometimes Class C and Class A. The bulk of our investors are in the Class B section, and then if you invest 500,000 or more, you get a nicer return because you're putting in a bigger check. And these are projected returns. So year one, we project cash flow um, distributions from operations 6,000, so 6% if you invested 100,000, and that would be paid on a quarterly basis. Now, if you did Class A, that's you get 10%. That's paid on a monthly basis. But so the first distribution will be August 1st, be about 1,000 to 1,500, and then over time we'll scale up as the cash flow increases. The big payout is when we do sell. We project year five. It all depends on, again, how the market is performing, but I'd rather underpromise and overperform. If we can more than double your money sooner, then and we may potentially sell earlier. And again, this is for Class B. For Class C, you're going to see a higher IRR and a higher equity multiple. You'll make more money through Class C. For those that have 1031 money, we've had people come in as a 1031 when it worked right, but also there's the opportunity to do a lazy 1031. We had someone come in with 2 million. We have someone that came in on this deal just under 600,000. We'll have another person as well. The timing doesn't always work out. You're getting the depreciation to minimize your tax liability. You don't have to sign on the loan. It just makes it nice and easier, and you get into a deal that you really like. Versus, I've seen people make the mistake of just strictly focusing on a 1031 and getting into deals that um, just don't make sense for them, and it could be a poor financial decision. So focus on the operator and their deal versus strictly focusing on I've got a 1031, I've got to put in another deal. So that's my 2 cents on that. I talked about aligned interest earlier, and so of the 110 million that we've raised, over 10 million has come from us, me and my team. They invest in these deals, and we we get paid after everyone gets paid. We do a European waterfall. So investors get paid back first, then we go to our waterfall. And if we do well, if the deal does well, then we do well. If the deal doesn't do well, which we haven't had, um, then we just don't get paid. So aligned interest, very important. We don't kill you with a lot of excess fees. We have 4 full cycle exits. Again, we like I said earlier, we focus on a few select markets so we can be experts in those markets. We like Arizona a lot. We like it because above average population growth, job growth, job diversity, a fixed cost in real estate taxes. The max it goes up is 5% a year, whereas other markets it can go up dramatically and get reassessed on a yearly basis. Insurance costs also are fairly low. Yes, we've had some, it's gone up a bit over time, but we don't have natural disasters. That's why they built these billion-dollar chip factories in Arizona. Insurance costs is relatively low compared to the rest of the nation. And also, Arizona is landlord friendly and business friendly. So that's why we like investing there. I live in California and I do not want to be a landlord here. So investment highlights why we love this deal: cash flow, predictable income from workforce housing demand right out of the gate, tax efficiency. You got that bonus depreciation from a cost egg study, whether you can use it now or you use it at the end of our hold. It really helps minimize your gains as far as from a tax perspective and really rocket fuel your net worth. Appreciation, we can force value through our operations, which I love. When we go visit a property before we buy it and do our due diligence, we're looking at all these different line items that we can improve, whether it's reducing expenses or adding some income lines, increasing occupancy. That's where the magic happens, and that's what happens once we take over the property. That's really the fun work that we do. And capital preservation, we're buying this at 50% below replacement costs, plus or minus. That really protects your investment. So to date, we've had a meaningful portion of this offering that's already has been invested into by existing investors and some new investors. But there is still room if you're interested. We also have some really great tools. If you click on this QR code, and if I'm going fast and you'll get a recording of this, you can go back and get the QR code or dig into any of the other information. And I will be happy to answer any questions you have. And if you have questions that come about later, certainly email me. You can book a call with me on our website. If you have questions with our paperwork, Jacqueline is always available. And to get to our portal to look at the PPM, we'll put the webinar up there as well. If you want the investment summary, it's all there on the portal. You can click that QR code. All right, let's see if we've got any questions here. All right, nothing there. Any questions? What I love about this deal is asymmetric return. So we feel that we've de-risked this investment extremely well, yet still has excellent upside. This is the time to take advantage of a very unique buying opportunity. and you may quick kick yourself a few years from now from not buying now. Any other questions? Well, I appreciate you coming and spending your time with us for the last 25 minutes. Again, if you have questions, don't hesitate to ask. For some people, I know they're very new to this, and any question to help you understand, we're happy to answer it. So thanks again for your time. We think Icon on Broadway is a heck of an opportunity. We'd love to have you invest with us. Have a great night. Thank you.